This question 21, it says the following shows extract from the statement of financial position of a company: non-current asset, inventory, trade receivable, cash at bank, debit balance, trade receivables, and bank loan repayable within 12 months. So question is, what is liquid or asset test ratio? So formula for asset test ratio is very simple, which is current assets minus inventory divided by current liability. So we need to identify what are the current assets we have here. Inventory is my current assets, trade receivable is my current asset, bank balance is my current assets. So and then trade payable and bank loan repayable is my current liabilities. Okay. So liquid asset does not include the inventory, so we will not include inventory. So 23,000 plus 12,000, which is your 35,000. 35,000 divided by 15,000 plus 40,000, which is my 55,000. Okay, so 35 divided by 55. So 35,000 divided by 55,000. And we can get the ratio out here, which is, this should be 1 and this should be 35 divided by 55. So 0.063, round it off, and then you can get 0.64. So this is our ratio. So correct answer is answer A. Next question, question number 22. The cost of direct material is increasing. What is the effect if a business uses first in first out instead of average cost for the inventory valuation in this situation? So when the cost is increasing for the material, when we use first in first method instead of average cost, what is the effect of this in cost of sales, purchase for the year, and closing inventory? Okay, if we can find out this, then we can answer this question easily. So to understand this, what we do is we will take example of the following table out here. Let's say as per the first in first method, first in first out method, let's say we are purchasing, we are purchasing 100 units at a price of 10, which is 1,000. And then second time when we purchase, the cost of material is increasing. Okay, so 100 units and rate is 15. Now I'm paying 1,500. Whereas in average cost method, when I purchase first 100 unit, it is 1,000. And then when I purchase second one, it is 1,500. So in average cost method, after you make two purchase or second purchase, you need to find out average cost. Okay. Now the average cost is total cost divided by total unit. Total cost divided by total unit. So the total unit in this case is 200. Total cost that I have is 2,500. So I can find out average cost as 2,500 divided by 200. So each product will cost me 12.5, which is my average cost. Okay. Now the twist of event comes when we issue inventory. Okay. If we are issuing inventory, let's say in this case we issue 50 inventory, then I need to find out what is the cost of that inventory first. As for the FIFO method, I will use the first in product here. That means this 100 unit. So the rate of that 100 unit is 10. So the cost of product that I'm issuing would be 10 times 50, which is 500. Okay, I subtract that. Now if I find out what is the value of closing or the remaining inventory is, after I subtract 500 from here, I have 500 left, and then 1500 from here, okay, which all together 2000. Okay, 2000 inventory left, and total inventory that I have is 50 from here and then 100 from here, 150 inventory, okay, which has different rates. Now if the same thing goes, and then if we issue that here, then now instead of using the cost, original cost, what we use is, we'll use the average cost here. So we are issuing 50 units, okay. Now the average cost per unit is 12.5. So now in this case, my value of inventory that I am issuing would be 625. Now the total cost of the inventory was 2500, 625 is issued. So the remaining inventory that I have is 1875. So let's consider that as my closing inventory. Closing inventory. Now closing inventory as per the FIFO method, it is 2000, and closing inventory as per APCO method, it is 1850. So that means closing inventory is more in FIFO method. Closing inventory is increasing. Okay, closing inventory is increasing, either this one or this one. Okay, let's select that. So one of this is correct. We know that if the closing inventory increases, then the cost of sales decreases. Okay, because when we have closing inventory in cost of sales, we have an opening stock plus purchases minus closing inventory. Okay, so when you subtract more closing inventory, your cost of sales will be less. Okay, so we can say cost of sales is decreasing here. If the cost of sales is decreasing, then there will be more gross profit, so the profit for the year will also increases. So your correct answer is D here. The closing inventory increases, cost of sales decreases, and profit for the year increases. Next question, question number 23. Q Limited employs machine operator and supervisors. Each machine operators produce 100 units per week. One supervisor can supervise up to 10 machinery operators and is paid 550 per week. Production is 7,700 units per week. So which type of cost is the supervisor's pay, and how much is their total pay per week? Now, supervisor salary that we pay is actually indirect cost. Okay. Now, in this case, indirect option is not given, and it is not variable cost because it doesn't change with the output. So it must be fixed cost. Why it is fixed cost? Because a supervisor can supervise up to 10 machine operator. Now, if you require more than that, then I need to hire another supervisor. Okay, and that supervisor again can supervise another 10. And if I need more than that, then I need to hire third supervisor, and so on. Okay, so that is how we can calculate the cost here. So it remains same or fixed for certain time, and then it changes. Again, it remains fixed for certain number, and then again it changes. So it is the nature of fixed step cost. So either the option A or option B is correct. Now let's see how much we are paying to these supervisors. Now how many units are we producing? 7,700 units. Okay, so total unit output is 7,700, and we know that each operators can produce 100 units in a week. 100 units in a week. So that means if I divide this with 100, then I will get how many operators we required. So 1700 divided by 100, this gives me 77 operators. We require 77 operators who produce 100 units per day, so that in a week they produce 7,700 units. Now, if we require 77 operators, then we need to find out how many supervisors we need to supervise them. So we know that one supervisor can supervise 10 employees or 10 operators. That means we know that the 7 supervisors can monitor 70. Okay. How many employees do we have? We have 77 operators. So that means extra 7 operator is managed by another extra supervisor. So altogether total supervisor that I required is 8. So we need 8 supervisors to supervise 77 producers or operators, and these 77 producers or operators will produce 100 units each week, so that we can produce 7,700. So the question is, how much are we paying them? So each week we pay them 550. So for each manager, so altogether we are paying them into 4,400. So 4,400 is my correct answer. Option B. Option B is your right answer. It is an step cost and we pay 4,400. Next question, question number 24. Which is a limitation of absorption costing? Okay, so you remember the chapter absorption costing. It is also known as total costing. Now here it says that it does not comply with accounting principles. Yes, absorption costing does comply with accounting principle, and it is not its limitation. It does not take into account all the cost of production. Again, yes, it does take into consideration all the cost of production. That's why it is called total costing method. We include both direct cost and indirect cost here. Okay. And then number C, it says it is not accepted for preparing published financial statement. No, absorption costing can be used and be prepared and publish that account using absorption costing method. And last one, it is not useful for improving the organization performance. Okay, so yes, it is true that absorption costing does not help in improving the performance of organization, because it takes into consideration historical data and only calculates how much it costs and what is OAR. So technically it does not help. Okay, next question, question number 25. The following information related to one accounting period: opening inventory 40,000 units, closing inventory 44,000 units, absorption cost profit is 284,000 and marginal cost profit is 250,000. What was the overhead absorption rate per unit during the accounting period? Okay, we need to find out what is overhead absorption rate, OAR, in that particular year. Whenever you see questions like this, then we just need to simply find out the difference in the units and different in the profit. Okay, so difference in the profit out here is 250,000 minus 284,000, which is 34,000, and difference in the unit is 40,000 and 4,000, which is 44,000, which is 4,000. So 34,000 and 4,000 is my difference. So overhead absorption rate is total profit or different profit divided by different unit output, which is 8.5 here. Okay, so 8.5, which is option D. This is your correct answer. Next question, question number 26. the selling price of a product remains constant. Okay, so selling price is constant. In which circumstances will the break-even point in units decreases? Now, if you remember the break-even point BEP, then the break-even point is my revenue. Revenue should be equals to my cost. Okay, this is my break-even point where my revenue is equal to cost. And we also know how many units we have to produce and sell. That is called BEP unit. Now the question here is, in what circumstances, if the selling price remains the same, in what circumstances the break-even unit may decrease? Okay, so for this to happen, the cost should decrease. Okay, so if the cost is decreasing, then I have a chances that my break-even unit will decrease. Okay, so let's go back to the option and then see. An increase in the labor cost per unit. So if the labor cost increases, cost increases. So that means I need to sell more units to cover up those costs. So this is not the correct answer. Number 2, a decrease in material cost per unit. Yes, so material cost decreases, cost is decreasing. So I can say I have to recover less amount. So my break-even unit may decrease. Okay. And third option, decrease in the variable cost per unit. Again, the cost is decreasing here, a variable cost. So variable cost decreases, which will decrease my unit, break-even unit. I have to sell less unit to cover up all the cost. And last one is an increase in total fixed cost. So fixed cost means cost is increasing. I have to sell more units to reach break-even. So this is not the correct answer. So the correct answer is either option 2 or 3. Oh, we have both here. Yes, option 2 and 3 here. This is my correct answer. Next question that we have is question number 27. A company makes and sells a single product type. The product is sold for $50 per unit and the variable cost is $30 per unit. Total fixed costs are $500,000. How many units of the product does the company needs to sell to make a profit of $300,000? Okay, so this is called a desired profit. Now, in order to understand this, you need to understand what is break-even point. Break-even point unit. So we know that in break-even point, we don't make any sales or we don't earn any profit or loss, incurred any loss. Okay. So that means if I can add profit in the break-even equation, then I can actually find out how many units I need to sell in order to make that much profit. Okay. Maybe most of you are confused here. So normally what we do is BEP unit, the formula is fixed cost divided by contribution per unit. Okay, this will give you only the break-even unit. How many units I have to produce in order to break even with my cost and the revenue. Okay, now here what I'm suggesting is if I can actually add profit here with the fixed cost, then it will give me how many units I have to sell in order to cover up all the cost and also earn profit. So this is the formula for desired profit. Whenever you see a desired profit and you need to find out how many units we need to sell, then what we do is we will write this equation and along with this fixed cost we add desired profit. Okay, so let's do that. Now the fixed cost in this case is given, which is 500,000. Desired profit is 300,000. So let's add them here. 500,000 plus 300,000, which is 800,000. Okay, let me write down step by step. 500,000 plus 300,000, which will give me 800,000 here. Okay. Now I need to find out what is my contribution per unit. Contribution per unit in this case, is $50 is my selling price, which is sales, and the variable cost is 30, which is now my BEP is selling price minus variable cost. Sorry, not BEP, contribution. Contribution is sales minus variable cost. Okay, so sales is 50 minus variable cost is 30, so I'm getting 20 out here. Okay, 20. Now if I use this contribution per unit in this formula, which is 500,000 plus 30,000 is equals to 800,000, then my desired unit to be sold is 40,000 units. If I produce and sell 40,000 units, then I will be covering up all the cost for that and also making profit of 300,000. Okay, let's see if we have that answer here. Yes, answer is D, 40,000. Next question, question number 28. A business makes and sells 3 different product type, M, N and O. The following information is available. These are the products and selling price, direct material, direct labor, variable overheads, fixed overheads, and the profit or the loss for each of the product is given to you. Okay. Now it says that each product uses the same material, direct material, which is in short supply. Okay, now we know where are we going to. It says in which order of priority should the product be produced to maximize the profit. Now if you look at here, it is very evident that I'm making $17 profit here, $10 profit and $5 loss here. So we can categorize this 1, 2 and 3, but this is incorrect. Okay, so whenever we do marginal costing, we do not find out the product or what do you call that, priority in the profit or the loss that we are earning for each product, but rather we need to find out what is my contribution and then find out my priorities here. Okay, so to solve this question, we need to find out what is the contribution for each of this. So 240, 280 and 250 is my selling price. Let me just write it down here. So selling price is 240, 280 and then 250 out here. Now I'll add up all the variable costs together here. Variable cost is direct material, direct labor and variable overheads. So 110 plus 65 is 75 plus 20, 95. So 195 here. Then 20 plus 90, 210 plus 30, 240. 240. After that 90 plus 100, 190 plus 25, 100 and 215. So 215. So these are my variable cost. So selling price minus variable cost will give you contribution, which is in this case 45 and then as follows 40 and 35. Okay, once we have the contribution, we can see that this one is M, this is M, right? M, N and O. M is giving you highest contribution, N is giving you second highest, and then O is giving you least contribution, even though his profit or the profit from O is $17. Okay, but we will not categorize in this priority also. Why? Because this is the problem of limited resources. What is the limited resources that we have here? It says that each product uses the same direct material. So the material that we are using here is in limited supply. So whatever material price we have or whatever material that we are using, we will divide that contribution with this material to find out how much each material or each dollar of material is contributing towards your contribution. Okay, so 110 here, 110, this is 120, I guess, 120 and 90. Okay. Now my contribution for each of this product is given. So contribution divided by total material cost, and it is this, each dollar is contributing is 0.40, and then similarly for others these are the numbers. So that means it is clear that M is contributing the most, so this is number 1. O is contributing second highest, so this is number 2, and N is contributing less, so this is number 3. So this is our sequence. We should produce M first, and if any inventory left or material left, then O, and then last one N. So this is the sequence or priority in which we produce the product. M-O-N, mon. Monday, mon. M-O-N. So yeah, this is the correct option. Number B is my correct option. M-O-N. Next question, question number 29. A business has the following information: break-even point 5,000 units, variable cost per unit $27, contribution to sales ratio is 40%. What is the total fixed cost? Now, in order to solve this question, we have two different formula to use here. One is contribution to sale ratio, and another one is break-even point formula. Okay, so to solve this, contribution to sales ratio is contribution divided by sales. So contribution divided by sales is 40. Okay, 40%. So that means 40 divided by 100. Now if I elaborate the contribution means sales minus variable cost. Okay, now if I find out what is my sales, then I can find out what is my contribution as well. Now in order to do that, I'll do the cross multiplication, and the cross multiplication would be 100 sales minus 100 variable cost is equals to 40 sales. Okay, now let's take the sales on the other side and the variable cost on this side. So we can say this is 100 sales minus 40 sales equals to 100 variable cost. Okay, now 100 sales minus 40 sales is equals to 60 sales, and 100 into variable cost, so 100 here into variable cost, which is $27, that will give you 2700. Okay, so 60 sales is equals to 2700, so that means sales is 2700 divided by 60, and if I do that 2700 divided by 60, then I will get, let's see, 2700 divided by 60, and it's getting 45. So that means the sales is 45. Okay, now if the sales is 45 and the variable cost is 27, then we can find out contribution is 45 minus minus 27, which is 18. So $18 is my contribution. Okay, let's do it on this side. Now, in order to find out break-even unit, we know that break-even unit is fixed cost divided by contribution per unit and that is giving me the contribution. So contribution in this case, or the break-even unit in this case, is 5,000 units. Okay, so it's equals to 5,000 units. Okay, now we don't know the fixed cost, but we know the contribution per unit. The fixed cost divided by contribution per unit we calculated, which is 18, equals to 5,000 here. Now let's do the cross multiplication. That means fixed cost equals to 5,000 into 18. Okay, so therefore the fixed cost is equals to 5,000 into 18, which is 90,000. So fixed cost is 90,000. Your answer here is C, 90,000. Next question, question number 30. Why does a business prepare budgets? Your options are to assess their non-financial performance. So budget will not help in assessing non-financial performance, so it is not the answer. To control their expenditure. Yes, the budget is prepared to control the expenditure, so this could be your right answer. Number C, to strategically plan several years ahead. Yes, it is to plan a year ahead, but there are so many other things also apart from budget. So, and also it is for the several years, like maybe 10, 20 years in the future. Okay, so budget is not for that long. Budget could be for maybe a year or maybe after that. Okay, and then last one is to value the assets and the liability of the organization. Again, this is not the right answer. So the correct answer for preparing the budget is to control their expenditure, which is our correct answer. So your right answer is B. I hope you liked the video. If you have any questions or concerns, please do comment and I'll try my best to answer all your queries. This was the question from 2022 May-June paper 12, and I'll be solving many questions in the future as well. Please do share, like and subscribe. Bye bye.